The private sector is divided into individual businesses, anything from the pizza parlor to the beauty shop to the accountant or lawyer to the car dealership or what have you. There are three legal forms of business ownerships, three ways that you can establish your business. Each of these has tax consequences. Each of these has advantages and disadvantages, and I'm not going to spend time in going over them. You can read them in your book. The first one is a sole proprietor. Basically, one person is the chief cook and bottle washer. He or she is the person who opens up. He or she is the person who closes down and sweeps the floor. A partnership, in many ways like the sole proprietor, except in the number of owners. There is at least one, and in some cases there could be many acting as either equal partners or in some cases silent partners. And finally, a corporation. A corporation, by definition, is a legal entity that has the same rights as any person in that it can purchase goods and services in the corporation's name, it can own land in the corporation's name, and it can sue other people and other corporations. Most of this you can just get out of your book. It's not a big, nothing that really needs a whole lot of explanation. The government's role. The government's role in our mixed capitalism, in our market system, is to provide a legal structure for us to do business, to provide a form of contracts, a form of courts to dispute them, to maintain competition, to be sure that no one particular company can monopolize the market and drive the price up by restricting supply. Redistribution of income, to take money through transfer payments, through taxation, through market intervention, and give it to those people who are less advantaged than others. And finally, the reallocation of resources. The government cannot literally come down and tell a business that he or she must produce less. When we talk about the reallocation of resources, we're talking about two different things. We're talking about positive externalities or negative externalities. We can also consider a positive externality as being a spillover benefit. A negative externality is a spillover cost. A spillover benefit is a benefit that spills over onto a third party. A spillover cost is a cost that spills over onto a third party. And what I divided up here, what I have up here, is an example of negative externality in the sense of pollution. Let us assume that we have a company that is polluting the Brandywine River. Currently, there's no incentive for that particular company to clean up the Brandywine River. Well, that pollution gets into our food supply, gets into our water supply, gets into our animals, the grains that we eat, the meat that we eat, and it can create problems for us. So the government comes in and says, this is what you are now providing. You are providing at S and D, at supply and demand, but these are goods that are just that are too costly. So therefore, we need you to supply less. The government actually can't make you supply less, but what they can do is through legislation and through taxes, they can dictate to you that if you produce a certain amount more than you should be, than we feel you should be, then you will be taxed on that. So therefore, because of that taxation, the supply curve moves to the left, causes the price go up to something a little more optimal, and the quantity going down. In this case, initially we have too many resources being allocated, and we want less. And therefore, this doesn't. The positive externality could be given to us. Years ago, we still have the disease called polio. The gentleman who discovered the polio vaccine, Dr. Jonas Salk. The only way, when they had the vaccine, only wealthy people, because the price of the vaccine would have been so high, only those who could afford it would get it. Well, if we only gave it to them, then those people other people would not be afforded the luxury of not getting the vaccine and therefore being subject to polio, and we would not actually have eradicated or eliminated polio from our list of diseases. So the only way is to be able to vaccinate everybody, inoculate the entire population. And in order to do that, the government came down and subsidized drug companies to make the polio vaccine. And then they distributed it to everybody so that in its initial consequence, everybody, in fact, was afforded the ability to get the polio vaccine. And to do that, what happens? We are initially at price P and quantity QE. Because of the subsidy, the drug companies are now being subsidized or being paid by the government to produce that. So the drug companies now want to produce more of that drug, and therefore the price of that particular drug would go down and the quantity of that drug would go up, and we'll keep those at PO and QO for optimal. In this case, we initially have too few resources and we want more. The last thing I want to talk about with this is the difference between a public good and a private good. A public good is a good that is not subject to the exclusion principle. Private good is a good that is subject to the exclusion principle, meaning that once the good is produced, only one person benefits. It excludes anyone else from benefiting from that particular good. But in a public good, once the good is produced, no one can be excluded. Everybody benefits. If we think of our military, once we have our military is dedicated to allowing all of us to sleep under the blanket of freedom that we do sleep under. There is no way of excluding that. If you don't pay your taxes and you have a robbery at your home, they still must come out and protect you or take the necessary procedures to try to get the culprit or what have you. So that's the basic difference between a public good and a private good. Again, if you have any questions, any concerns, anything at all, place them on the discussion board page of Blackboard, email me personally, and I will put the answer up there. Thank you very much. Have a good day.